Hi, Blake. You made it.
I never know if I can get home from school by 4.
Gotta drive fast, but not too fast.
Yeah, there was no way I was making. We don't finish till 3:45, and there's no way I'm getting back home.
Well, I think we might just go ahead and get started. We have John and Alan here to go over financials. I did drop those in the team site. I don't know if people saw them or not, but I did drop them in the team site. And then we'll let John and Alan go through those. And then I think they're also prepared to discuss some asset allocation information as well. So take it away.
Alan, you're on mute.
Okay, you can hear me now, I assume. Okay, sorry about that. Thanks, Kathy. I'm going to share my screen. Can everybody see this, the report? Okay, so same format as usual. We'll start with the investment policy statement review. So the page, this page here shows various guidelines straight out of the investment policy statement. Cash, for example, the range, acceptable range is 0 to 10%. As of June 30th, it was at 3.1%, and it's between 2 and 3% currently. So within guidelines, fixed income, 71% weight as of June 30th was in guidelines. Overall, all the fixed income guidelines, or excuse me, we're in compliance with all the fixed income guidelines. So the portfolio is in compliance with all the fixed income guidelines, so nothing to note there. The same with equities. Equities can be a 10 to 30% weight in the portfolio, and they were slightly less than 26 at June 30th, which is fairly common. We creep close to 30 sometimes, but if we do, because of market movement, we trim it back. And so we're usually at 25 to 26%, and that's where we were at the end of the second quarter. Other limitations, investments in any one corporation, and this could be investments in the stock of a corporation as well as investments in the bonds of a corporation. We were at 1.8%, and I believe that was Walmart. And Walmart has been close to a 2% weight overall in the portfolio because we not only hold the stock, we also hold some of the bonds as well. All the other guidelines, which are related to fixed income, the portfolio is in compliance with those guidelines. So nothing to note here. No need to rebalance because of the guidelines or adjust any of the holdings as a result of out of compliance with the guidelines. Moving on to the next page, just a quick review of a little bit of a rehash of what we saw on the prior page. As of June 30th, the fixed income weight was 71%. Equities, it was close to 26, and about 3% in cash. So fairly normal levels for each of those broad asset classes. The asset allocation over time, you can see what that looks like, or what it has looked like over time by taking a quick look at the bar chart in the bottom left of the page. So the navy blue portion of the bar is equity, the gray portion is fixed income, and then the small light blue portion at the bottom of each of the bars, that's cash. So basically what this tells us is that, especially in the last 3 years, or really 4 years, the equity and fixed income allocation has been very consistent in terms of percentage weight of the portfolio. So it's just a quick way for us to see and to remind ourselves what the allocation has been over time. On the next page, we have performance for the entire portfolio as well as for each of the asset classes. The total fund performance, that's net of fees. So that's one thing to keep in mind, as usual, net of fees. And so for 1 year, we can see that the return was 8.2%. The policy weighted benchmark was 5.7, so outperforming the benchmark. One thing to note about the benchmark is that in recent weeks we have changed, or for for this report, we changed the blended benchmark. Previously, it was, I'll go to the definitions. It might be easier to discuss this. Previously, it was 75% Bloomberg Aggregate Bond Index, 5% US, 5% 3-month US Treasury, and then 20% MSCI Value Index. So what we did was, because we added the large cap core equity allocation to complement the large cap value allocation, and it's about a 50-50 weight now. What we did is we split the equity weights used in calculating the benchmark about 50-50. So for example, 10% of the weight of the benchmark is the MSCI Value Index, and 10% is the MSCI USA Index, which is a combination of growth and value strategies. So that, going back to here, that what we just discussed is the definition of the policy weighted benchmark. So that only goes back to, we only calculated that back to April 1st because that addition of large cap core occurred in late March. So it's only been effective for 1 quarter. Really, this 3-month category is the only category that's affected on this page. The 1 year would have, well, I shouldn't say that, excuse me. All of the categories are affected, but only 1 quarter of all the categories is affected. Hopefully that's not confusing, but that's an important distinction, and I won't go into it further unless there are any questions. For example, as I mentioned, 8.2% return for the entire portfolio net of fees over the 12-month period ending June 30th. The benchmark had a return of 5.7 over that same period of time. Looking at the components and, how do we achieve that outperformance? Part of it was, very small part of it was cash had a yield of 5.8% in the 12 months ending June 30th. So that's very high, bolstered by short-term treasury rates being very high compared to what they've been over the last 5 years. 3-month treasury bill had a 5.4% yield over that same period of time, for example. Fixed income, very large weight in the portfolio. Almost always is going to have, not always, but almost always is going to have a lower return than equities, but it had a 5.5% return in that 1 year period versus the benchmark at 2.6. And when we talk about the fixed income characteristics, we'll talk about some of the drivers of that outperformance. A good absolute performance there and good relative performance as well out of fixed income. It's a very large weight. So that's going to drive a lot of the return that we see here in the top row in the fund, top row in this table. But then equity, of course, it's a smaller allocation, but it's going to show, it's going to have a lot higher returns. It could also have a lot lower returns than fixed income. What we see here is total return for equities across all the equity categories, 14.89%, almost 15% versus the benchmark a little over 17. So a difference of 2. Some of the good absolute performance for sure, 15% in a 12-month period is well above the average of 8 to 9%. But we are lagging the benchmark by about 2%. And some of it is just simply, to sum it up, there are lots of details to it, but to sum it up, it's been very difficult to keep up in a very strong market. We feel like we are very well positioned for markets that produce returns that are near that historical average of 8 to 9%. But when they get elevated well beyond that, which they were in the 12-month period ending June 30th, it's difficult to keep up because you tend to have a lot of weight in lower quality stocks. And we don't do that simply because they tend to be more volatile. And also they tend to not outperform the benchmark over longer periods of time, 3 years, 5 years, for example. So the investment team is always focused on the absolute and relative performance of the equities as well as the fixed income, and always working to improve that. But it has been a fairly difficult period, and given the high returns in the equity market, nevertheless, they remain confident that they will be able to outperform when equity market returns revert more to the normal of 8 to 9% over a 12-month period. Any thoughts or questions on anything on this page or any of the prior pages before we move on?
So one point, Alan, in regard to the equity performance, one of the things that's not reflected in the benchmark is we do have exposure to small cap domestic equities as well as we have a specific REIT portfolio, and those underperformed large cap equities, particularly for the last well, it's been a while now since they've been underperforming. So that pulls down the equity performance a little bit, but it's not in the benchmark, so it's a little failure to be apples to apples completely. But that explains some of that disparity as well.
Good point, John. If there aren't any questions, we will move on to the next page. John, do you want to take it from here?
Sure. Thank you, Alan. And we'll start out by taking a look at the various components of your portfolio and the characteristics of each of those, starting with the fixed income, which, as Alan mentioned earlier, is far and away the largest component of your portfolio. And you can see in the upper left-hand corner the characteristics, the yield figures, yield to maturity and the current yield, both over 5%, the current yield just over 5%, the yield to maturity or call at about 5.5%. Continues to have good quality, with the average quality being A1. Just to remind you, the highest quality bonds have a AAA rating. And then as you go down the quality spectrum, it's AA, single A, triple B, and so on. Then you go through the C's and you finally get down to D. But anything that is triple B or higher is defined as investment grade. So you are comfortably above that level at your A1 rating. And then you can see the benchmark is just a little bit higher at AA2. Yes, they do distinguish within the A and AA in terms of gradations 1, 2, and 3. So just to give you a little more detail, average maturity just under 9 years at 8.85. That compares to the benchmark at 8.4. And the effective duration 5.6 versus the benchmark at 6.1. What that effective duration figure, just to remind everyone again, it tells you the sensitivity of the portfolio, the fixed income portion of the portfolio, to changes in interest rates. So what it's saying is your portfolio has a lower level of sensitivity to changes in interest rates than the benchmark does. And it's been an interesting year in fixed income, because we saw earlier in the year interest rates increased, and we saw total returns from fixed income actually negative. But over the last few weeks, we've seen a significant change where rates have fallen, and fixed income actually has a positive year-to-date performance now. And as Alan alluded to, a nice performance over the year ending June 30th. Directly below that is the sector allocation, to give you a sense of how the bonds are positioned within that portfolio, the types of bonds. And you can see the largest component of bonds that you have in your portfolio are corporate bonds. This has been a good thing. Corporates will have a higher yield than Treasury and other government obligations, simply because there's a perceived higher level of risk associated with them. So typically right out of the gate, you're going to get a little better return because they have higher coupons or income associated with them. So that is beneficial to the portfolio. And you can see that weighting at 59% is over twice what the index has, or the benchmark at 24.6. And as I've pointed out many times, the municipal bonds, they are municipal, but they're not tax exempt. They're taxable municipals. So just to alleviate any concern that we're focusing on tax exempt investments in a tax exempt portfolio, not the case. Quality distribution at the bottom of the page, you can see once again how the portfolio is distributed by quality segment versus the benchmark. And you can see that we do have an array of bonds in that BAA or triple B, still investment grade, but once again, higher yields with a little less exposure to the governments, which have the highest rating, the AAA, but we are actually ahead there. It's the AA rating where we are significantly underweight relative to the benchmark. So overall, good quality, overall, nice income levels that you're getting on your bonds. So everything positioned well in that segment of the portfolio. And please stop me with any questions that you might have as we walk through these various asset classes and the review of their characteristics and holdings. Next page, on page 6, is the large cap value. You'll recall we've used this strategy extensively over the years because as we went through the period where interest rates were so very low, we migrated most of the equity exposure into this type of equity because it does have more of a focus on income. As you take a look at the dividend yield, you can see it's about 2.8%, higher than its benchmark at 2.3, but significantly higher than the overall stock market, which is less than 2%. So we utilized this particularly over the years where interest rates were so very low as a way to enhance the income production of the overall portfolio. As Alan mentioned a moment ago, we have added a large cap core strategy to the mix, a little bit more focus on growth and a little bit away from the emphasis on income since we have seen interest rates come up somewhat. And then directly below those characteristics, you can see the sector allocation, which gives you an idea of how the portfolio is positioned relative to its benchmark. And these are economic sectors in terms of the breakdown. So communication services includes companies like Verizon and AT&T and T-Mobile, but also Meta platform and the old Facebook, and also Alphabet, the old Google. So those are the types of companies represented there. Just to give you a little more definition, some of them are a little more self-explanatory. Consumer staples are those things that consumers buy on a regular basis: food, soft drinks, detergent, etc. Energy and financials pretty much speak for themselves, as does healthcare, industrials, and information technology. Materials, basically chemical companies, those types of companies represented there. And then in terms of real estate, we have real estate exposure within this portion of your portfolio. Within the large cap value, we also have a standalone real estate portion that I'll go through in just a moment. In the lower right, the top 10 holdings, you can see many of these are names you're familiar with as a consumer. Walmart, Procter & Gamble, Johnson & Johnson. I'm sure you're all familiar with JP Morgan. So once again, larger companies, more well-known, stable, high income producing, and lower valuation than the overall equity market. So we refer to that commonly, or at least I do, as the belt and suspender strategy, because you do focus on lower than market valuations and higher than market income. So moving to page 7, we will touch on the large cap core strategy. This is the one that was introduced just a few months ago. And so as you take a look at it, you'll notice it has a higher PE, lower dividend yield. So more focus on growth in this portfolio than the value strategy, which once again has that higher emphasis on income. And then once again, directly below those characteristics, you can see the sector allocation, and a little different mix than what you saw in the value portfolio is, for example, you can see technology is right around 30% of this portfolio, 30.5% for the benchmark. And as of June 30th, we were at 28.5. So the common companies that you hear about in this sector, the big one today, NVIDIA, which released their second quarter earnings, but you have Microsoft, et cetera, Apple, all represented in that sector. So the top 10 holdings in the lower right corner, once again, names that you're very familiar with: Amazon, once again, Walmart, NVIDIA, Apple, Microsoft, et cetera. So once again, large, well-established companies that we still feel have significant growth potential into the future. On page 8, we have the small cap stocks. You can see in the equity characteristics, they're much smaller, an average market capitalization for this part of your portfolio of just a little over 5 billion. When you compare that to the core strategy that we just looked at, which was 853 billion. So much smaller companies. As you can see, our valuation as defined by the price earnings ratio, much lower than the benchmark, and our dividend yield exactly the same. So same breakdown directly below that in terms of sector allocation, so you can see how the portfolio is positioned relative to its benchmark. And then the top 10 holdings in the lower right, not quite as well-known names in here. You might be familiar with a few of them, but typically you're not going to see as many names you're as familiar with as you did in the large cap strategies. We don't have it delineated out in the report, but I can tell you this strategy has done extremely well relative to its benchmark. Small caps have underperformed relative to large caps for the most part, but the strategy is doing extremely well on a relative basis. So good to see that in a segment that isn't performing as well as the larger cap stocks. On page 9, we have the international strategy. And just to remind everyone, this strategy is invested in what we call ADRs, American Depository Receipts. So it allows us to invest in international companies, or I should say foreign companies, without having to utilize foreign stock markets for the trading purposes. These shares are traded on American exchanges. They're called American Depository Receipts. They are receipts that are backed by shares of the foreign company. So it allows you, once again, to trade foreign companies on domestic stock exchanges. So you don't have to worry about what particularly is going on with exchanges outside the United States, because you're able to trade them here domestically on American exchanges. So just to give you a sense of the characteristics, once again, a more modest valuation in terms of the PE relative to what you saw for the domestic markets. That's been the case for some time. And historically, the international markets typically have a lower valuation than the US markets. And once again, a nice dividend yield at 2.7%. So once again, generating some nice income. The sector allocation directly below, and then the top 10 holdings. Some of those names probably familiar: Unilever, big consumer products company; Nestle, the chocolate company. So not totally unfamiliar in terms of the composition of this segment of the portfolio. And then finally, we have the real estate segment. And you'll recall, for those of you who have been involved for a number of years, we added this several years ago, once again, as a way to enhance the income in the portfolio, given how low interest rates on the fixed income segment had fallen. So we added this component. As you can see right now, the dividend yield is 6.4%. So very nice. From a total return perspective, the real estate area hasn't been that strong. As interest rates have gone up, that gets to be a concern in terms of real estate companies, because it's not unusual for them to carry significant levels of debt. So as interest rates go up, their debt prospectively becomes more expensive. But on an income yield basis, it continues to generate a very nice return of over 6%. So with that, that concludes the review of the various components of the portfolio. And once again, are there any questions that I might be able to answer?
Okay.
Okay. Here, I was going to say, hearing none, I will turn it back over to Alan.
Okay. So let's talk about asset allocation, and I'll switch presentations. And I think Blake, I think you originally asked the question, and we do this occasionally, not quite every year, but pretty close. And so what we did was we looked at various combinations of fixed income and equity, and then using historical returns, about 3 decades worth, we did some calculations to derive an expected return as well as a standard deviation, so you can get an idea of what the variability around the historical or the expected return might be. So for example, with a 75% fixed income weight and a 25% equity weight, which is roughly what the portfolio is now, we would expect a return all in of about 6.2%. So that would be income from the portfolio as well as appreciation on the holdings, 6.2%. And then the standard deviation around that we would normally expect that to be 5.1%, or that would be excuse me, that would be what we would expect. It could vary from that, but in general, that's what it would be. Sorry, I'm just repeating myself. All right. Sticking with this theme, if we change the fixed income allocation to 70% and increase the equity with the difference, so increased it to 30% from 25%, that expected return to go up from 6.2% to 6.5%. As we introduce more equity, the standard deviation is going to go up as well. So 5.6%. And then 65, 35, you can see another 3 basis points, or another 30 basis points, or another 0.3%. The expected return goes from 6.5% to 6.8%, and the standard deviation creeps up to 6.2%. And then finally, at 60-40 fixed income equity, we get to an expected return of 7.1 versus the standard deviation of 6.8. So overall going from where we are to, if you went from 25% to 40% equity, you can see that you don't pick up quite a 1% return increase. It's a little lower than that, but it's in that neighborhood. And then the standard deviation, you can see here it would go up by more than 1.5%. So, and that's the introduction of the equity. And very basic calculations, but in our experience in doing these types of calculations over long periods of time, I've been doing this type of stuff for about 2 decades. John's got more experience than I do. Jeff's got more experience than I do. No offense, John. That's all good. But these expected returns do hold up over time. One thing that I will say is that the markets tend to revert to these historical returns. And you end up getting returns like the expected returns we have here in the table. The one thing I will say is that the historical returns for the equity market have been elevated for about the last 12 years. So that could continue, who knows? But on average, the S&P 500 has produced a return, I think it's over the last 2 years, including 2022 when the market was down. I believe the 10-year average is still above 10%. I think it's above 10% for 12 years. So that's a long stretch. And I think back, we used to say, we haven't been saying it much this year. I don't know why. It's still true, I'm sure. But back in just a year ago in 2023, we would often talk about how the last 10 years, the 10-year period ending 12/31/23, I believe, is the best 10-year period in the history of the U.S. equity market. And prior to that, the best 10-year period in the history of the U.S. equity market was 2021, back 10 years. So it's been a very good stretch for the equity market over the last 12 years, with the only real, there's been dips in there, sure. 2022 was not a highlight either, but it's been a very strong equity market. It could skew these numbers up a little bit, but probably not any more than 0.25%. So another way to look at this is that the expected return for the current allocations could, over, discounting the last 10 years, it might be 6% instead of 6.2. And then that 60/40 allocation, instead of 7.1, it might be 6.8, something like that. But nevertheless, this gives you a sense of, what you could expect with different allocations. Thoughts? Interested to hear your thoughts, Blake. I know you think about this stuff quite a bit, and interested to hear what your first impressions are.
Well, I had raised my hand and then you answered my question, which was when we look at expected return is sort of how far out is that expected return sort of average? That's not the right word, but the best term in terms of how far should that be viewed? And you answered that question that in a sense, it is a long-term look, that assuming the trends of the last 30 years, which are calculated here, that's where we're looking at. Can you talk a little bit, or maybe like apply an example of, so let's use the 75/25, and it says expected return is 6.2%, and then the standard deviation is 5.1%. Can you walk me through what exactly that means when we see the standard deviation of 5.1%? When we've looked at this chart or this kind of chart in the past, we tended to look at it in the range of what it would actually possibly do for an expected rate of return, because I know that the conversation sometimes when we start having this conversation about asset allocation tends to go to the doom and gloom. And we absolutely want to consider that. But I think we also want to consider the long-term, the 10-year impact, the 20-year, the 30-year impact, knowing that retired members talk a lot about wanting to be able to push and bump up that excess earning number because that's critically important for their success. And those people that are still active employees, we're still playing on our perspective, the game of catch up. So if you could talk about the standard deviation and what that number means, that would be helpful.
Yeah, I think from our perspective, the way we think about it is probably a little maybe simpler than what an actuary might think about that. And I wouldn't want to speak for Lucy on this, and Lucy, feel free to chime in if you think that any of my comments are sideways. But it's good. Well, how we would explain it and think about it's probably more simplistic than what an actuary would think of, how an actuary might think about this and explain it. But to us, we think about it. Let's use, rather than be hypothetical, let's use the current allocation of 75/25 and the expected return of 6.2. So it would be perfectly normal for the returns in a given 12-month period to be 5.1% less than this expected return. They could it would be very normal for them to be almost 1 or flat. And it wouldn't be very unusual for them to be 10% less than this expected return of 6.2%. More than 10%, that's infrequent, but it does happen. And in fact, in today's markets, it happens more frequently, or we see more instances of multiples of the standard deviation be achieved to the upside or the downside than that's happened more in the last 10 years than it happened, I think, in the prior 25 or 30 years. So volatility is increasing is another way to put it. So I think just on the numbers, what it wouldn't be unusual to see the return in any given year be 5% to 10% less than this expected return of, call it 6%, just to round it off. That's one way to think about it, or one way we think about it. So when we talk to clients and talking about their equity allocation and sort of trying to manage their expectations, just we want them to know what's normal and what's not normal. And so when the market declines, just like it did a couple of weeks ago, the S&P 500 was down 9.5. I might have been down 10% at one point. It was down about 10% from July 16th through the first week in August. It does things like that it can do things like that pretty quickly. It's recovered all of that, but that's a good example of what can happen and how fast it can happen. And in this portfolio, wouldn't do that because we're only at 25% allocation to equity. But if we were 100% allocation to equity, the entire portfolio would have went down 10% in a matter of about 12 to 15 trading days. So that's one way we discuss this with clients. The other way is, and it depends on the type of client, but if there are clients that make frequent large distributions out of their account, this is one we typically talk through data like this, because what you don't want to do is you don't want to have to make a large distribution from an account at a time when the market is down. You want to make distributions when it's near the middle or it's nearer a peak. You only know that in hindsight, but one of the worst things you can do is draw a lot of value out of the account when it's at a low, because you have just that much less in assets to appreciate when the market goes back up. Again, that's just another way we look at it. John, do you have any other thoughts or anything to add on that? This is all very simplistic. I think I guess I'll say one thing here and to finish it, and then John, any comments you want to make or any comments anybody else wants to make, feel free. But the context here, I think maybe that's most important is the funding status. And so we don't have data as of June 30th, 2024, or this year, for example, but we do have it back from June 30th of 2023. And so the asset value at that time was $185,267,000. The liabilities were $210,327. So the assets or the investments were at $185 million roughly, or less than the liabilities at $210 million. That's a ratio of about 88%. So the funding status, as we might say, was about 88%. That's not bad. Ideally, you want it to be 100%, but it does fluctuate with actuarial determined expectations or liabilities, as well as fluctuations in the market. And the key for this plan is to take enough risk in the portfolio to achieve 100% funding status, but not take so much or not take excess, because if you don't need it, simply because that just introduces more risk into the portfolio than is otherwise necessary. And certainly with, I believe the school district, if it isn't if it needed to be funded or funds needed to be added to it, the school district would be, I believe, obligated to do that based on the plan documents. And so overall, the context here is that taking the right amount of equity relative to the risk is really important, because you want to take enough you want to take enough risk to hit that 100% funded status. You want that to be the funded status on the last day with the last participant in the plan. It doesn't have to be, it's going to fluctuate around that number between now and then, but that's what you want to achieve, is that 100% funded status on the last day with the last participant. But you want to be careful not to take too much risk. You don't want to have that equity allocation be any more than it needs to be, because all you're doing at that point is increasing the risk that the district might have to add assets at some point. We certainly don't expect that to happen, but nevertheless, it's a risk that has to be accounted for, and we have to be thoughtful about it when we talk about the asset allocation. Anybody, any other thoughts, questions?
I just have a question. This is Barb. I think we talked at the last meeting. Suppose we went with a 65-35, would that, right now we're pretty much 75 fixed, 25 equity. If we allowed this, went with the 65-35, would that allow you to be closer to that 30%? Would that make any difference?
I think, theoretically, yes,
Mhm.
but it also introduces more risk. And these are estimates, and it requires a conversation not only with us, but I think with the actuaries as well, as to see, is there a need for that? And we're seeing one side of the situation, the investment assets, without fresher liability data. It's hard to say. And even then, if you have current data for both of those concepts, then it's a moment in time, and it fluctuates from there. But what we've seen is that there has been a lot of time in the last 10 years in this plan, I believe. I don't have all the data right here in front of me, but there's been a significant amount of time in the last 10 years where this has been, I believe, 100% funded. So
Yes.
That would suggest it may be necessary because we're underfunded. I hate to even say it's underfunded now, because again, it's a moving, I wouldn't say it's a moving target, but
Yeah.
the numbers move every day the market opens, and
Sure.
the numbers move every time there's a life event with someone in the plan. So it's looking backwards, looking back and saying, well, what's the funded status been over the last 10 years, 20 years, and longer? In John, I think, the first year I was involved with the plan, I think might be 2006. And I think John's time with the plan goes back further than that, all the way back, with Bob Hobson, et cetera. And there was much of that time where it was fully funded on a 5% equity allocation or a 10% equity allocation. So it's a good question, Barb. But it definitely, I think we could sharpen the answer to that with a little bit fresher liability data. And even then, I would, from our experience, I think where the funding level back on June 30th, 2023, it's definitely in the ballpark of where we'd expect it to be.
Okay.
It's not, there isn't a huge gap there, and that gap can close very quickly.
So therefore, you're very comfortable with where we're at right now in terms of.
We are. Right.
Okay.
We are from our perspective, but just
Okay.
know that, we're looking at it from one perspective.
Sure.
And that's based on a couple of decades of experience with the plan, where it's dipped before, it dipped during COVID, it dipped during the financial crisis in 2008, and those gaps were bigger than what it is now. And I think now it's very much a point in time, and it even matters. I think the direction of the funding it was at 88 on June 30th of last year, and I think it's probably in the 90s now. It's not in the low 80s now.
So
it's probably in the 90s. So it was going up as we were coming out of a weak market in 2022, and the market has increased. The S&P 500, for example, is up 19% this year. So the equity market has increased significantly from June 30th, and so that's why we're saying it was 88% 14 months ago. It's probably low 90s now.
Okay.
And just to
Thanks.
piggyback on that, we're just finishing up actuarial reports, so we should have some of that data here soon. I was just communicating with the actuaries on it today, so hopefully we'll be getting some reports here shortly.
Yeah, that sounds good. Thanks, Kathy.
Yes, thank you.
Blake,
I have
you have your hand up, Blake?
Yeah, I'm going to make a comment and then I'm going to ask a question. So my comment was where Barb was coming from is that we were having a discussion last time about, I think in our mind, when we see and know that our investment policy has been written to be 70% fixed income and 30% equity, it seems like there's always a little bit of a buffer, and that we're often, when we see these quarterly reports, actually sitting a lot closer to 75-25. And so our discussion is that if our committee's desire and what has already been approved through the school board is a much clearer understanding that we would be a lot closer to seeing 70-30, if that's the practice that we want, is the actual right investment policy statement to actually say it's 65% fixed income and equity is 35%, knowing that then kind of over time as things ebb and flow, that we're actually going to be a lot closer to an actual 70%, 30% than where we are now. And I know for me, as I look at the data, I actually feel very comfortable with that, because the conversations, and I even went back and watched some of the video of our meetings, I think that was our understanding, and the guidance and the direction that we were giving was we were thinking we would see much more frequent fixed income number closer to 70 and equity much closer to 30 than the 75-25. So I think kind of to piggyback of why Barb asked that question and why we had that conversation. And so my ask there is, if we were to have a fixed income equity policy that was 65-35, is it fair to say that sort of most of the time, because of the ebb and flow of where dollars are going, that it would actually, on paper, the practicality is it would often look a lot more like a 70-30? So that's question number one. And then the second one was that Barb asked you the question about, are you comfortable with this? I want to be really honest. That question and that answer really makes me nervous, because when you say that you're comfortable, I want to know based on what. And I will tell you, as a committee member, that's often been my struggle, is that we talk about this idea of, oh, we're comfortable with this, or, oh, it's doing fine, but based on what metrics? I think that has been a struggle for me as a committee member and this committee as a whole. And I know as I communicate to school board members, is what's our metrics? You know, I hear that one of our metrics is the funded status of the plan.
Mm-hmm.
Second, I think, is our actual rate of return that we're actually giving and members are earning. Third, I hope is applying that also in terms of excess earnings. Fourth is sort of making sure that we have good quality measurements of what is the life expectancy of the members of the plan, and are we lining those things up so that our numbers make sense. But I also think the fifth one, which is the one we don't really like to talk about and run away from, is there is this other element of the component of trying to close this gap that's been created for people who made that commitment of the Des Moines teacher retirement system versus IPERS, and that gap that exists. And we've done a really good job as a district of doing our best to do things like offering retirement incentives, recently this last year trying to close some of that contribution gap by contributing into the 401A. But I struggle with that really quick response about being comfortable and making sure that we know what our metrics are and what that actually means.
I'll start with your last question. And I'll go back to the first one. We're comfortable with it from the perspective of the management of the money. And we know what the funding, and that's really the only perspective which we can comment on it from. And my comment about looking back in the past and noting that the funding status was at 100% for lots of time, many quarters, that's just a reflection on history. That has nothing to do with, we don't know what the reality of, and we're not saying as investment managers, we're not saying what we think what the funding status will be moving forward. So I think the only thing we can comment on and say we're comfortable with is we are comfortable with the asset allocation as it is, simply in terms of delivering returns that that are expected. And I know if you want more return, then we would have to adjust the asset allocation to deliver that. But again, it is, Blake, definitely, we are only talking about it from one perspective. We are only the investment manager, and I know you know that, so I'm not trying to be abrupt or anything with that comment. I think, I think the way, I think as a committee, you'd want our comments about the investment performance and the investment portfolio. And then from the actuaries, you'd want comments about all of the things that they comment on, and then you would want to combine those two to see if, as a committee, you're comfortable with all of it together. And so we're obviously only one piece of it. Maybe we're only a third of it. We're somewhere between a half and a third of it. So that's all we can do is comment on the investments. John, anything to add to that?
Well, I think one of the things, and I understand the question. So, if you officially change to a 65-35, would that get you to the 70-30 more precisely than what we've done now? And I understand that. So that made sense to me in terms of what you potentially are trying to accomplish. I think the other thing that we do have to keep in mind that has to be factored in, and maybe that's not reflected in your investment policy enough, is we will be maintaining cash balances in the portfolio because we are in a situation where we do have the distributions to make every month. So we do have to ensure that we do have the cash available. I believe we're in a situation now where the outflow exceeds the inflow in terms of contributions. So we are going to have some significant cash there. So I think one of the things prospectively, you can see the range is as portrayed on the screen here, or displayed, excuse me. 30% is our maximum. And as Alan pointed out, when you are in a rising market, let's say we went to 29, then we would prospectively be bumping up or over that 30% periodically, where we would have to be going in and trimming, also recognizing that we have to maintain some cash to ensure that we're able to timely make the distributions for the payments to the retirees. So that's one of the things to consider. I think one of the things, if you want to make 30% your target, we could establish a range that goes above the 30. If 30 is your target, right now you see the range in the IPS is 10 to 30. 30 is the maximum. So if you would want to be more at that 30, you could say, well, it'll be 10 to 35, which would allow us to go more specifically right at that 30.
Yeah, I think if you want us more commonly at 30% equity, you would want to get permission from the board to switch to this. And then is that a fair statement, John? Or are you thinking something else?
No, I think that's a fair statement, but also it could prospectively be accomplished by just widening the ranges. I mean, because as you showed that just a moment ago, the equities go from 10 to 30.
Mm-hmm.
If 30 is the target, can you just expand the range to 35, where the target is still 30, but the range allows for some movement above that 30% ceiling?
Yeah, I mean, and then conversely, we would move this from the bottom end or the minimum on fixed income to 55 so that the math works.
Right.
Yeah.
And I don't know if that would require board approval. I mean, because you're obviously just tweaking it, but that may be substantial enough that the board would have to be a participant in that discussion and approve it. But that would be a very simple way to move you closer to that 30, acknowledging that we do have to keep not an insignificant amount of cash on hand to ensure that we're able to meet the distributions every month. Because obviously there's cash flow that comes in through dividends and interest and bond maturities on occasion, but we don't have that timed perfectly to where it funds the distribution every month. So we have to maintain some cash in there to ensure that we're able to do that in a timely fashion. We don't want Kathy to ever call us and say, where's the money? So we want to make sure that happens automatically. like clockwork month after month.
My follow-up is to you, Kathy, and you may not have an answer to this right now, so this may be something that has to come back to us, is what are your thoughts in terms of, as we have the conversation, and I'm making an assumption here because we had talked about it during our last DMTRS board, are you thinking that we're talking about an actual investment policy modification, or do you think sort of what John was outlining there, that if we change within these percentages, does that need to go to the board or not? My instinct looking at that, because we call it policy guideline, is that it would need to go to the school board, but I'm just curious what action would be appropriate to get us closer to the 70-30, which is where I think we believed for years that we were going to end up eventually landing to. And I think the reality is the practicality of the dollars just means we're always going to be a couple of % off. And that's not life-changing numbers, but that's how we want, I think that's how we want to keep moving the needle forward, as we have now for about 5 years.
Right, and I think I'm kind of leaning with you on where, when it says investment policy statement range, if it says 35, then to me, that's outside of what our investment policy says. So I would be more comfortable probably having a revised investment policy statement go to the board. And I don't know if there needs to be a revision in how that's written. So if it says now 35%, do we put in there with a target of 30, or do we not even go there?
It's just on the I think, to me, the cleanest way to do it is there's a table it's on the last page of the investment policy statement that provides the ranges, and I would just switch those. I would just adjust them just like we discussed. And, we need a new signature on the investment policy statement from Shashank or somebody authorized to sign it. And then I know the last time we changed it, that was, there was board approval before we changed anything.
Right. So we will be taking the annual report and all of those things forward to the board. I'm wondering if we do it all at the same time, which won't be probably for another month, probably maybe the first meeting in October, but I don't think that will make a huge difference in our investment strategy. But if we could do that all at once with that information, I think that might be the best route. Are you guys in agreement with that?
I agree and support that.
Have we had the plan actuary opine on what a change in expected return and risk would mean for participant outcomes, both like retirees and actives? Because my thought on this has been, I don't know if there's a string you can push on necessarily to help improve the actives standing with this plan or the outcomes from this plan, given the excess earnings mechanism that's in place. If you increase returns, what ends up happening is a lot of that gets pushed to the retirees through the excess earnings mechanism, and not as much gets passed to the actives outcomes. And so you have the actives sort of taking on more risk and not realizing much, if any, of the benefit or the upside from the risk. And so I'd be curious what the plan actuary would say around if you were to model out higher expected returns for your actives in like the 40 to 50-year-old cohort. Does their outcome materially change, or is the better way to improve those outcomes to, push more contributions into the 403B type plan off to the side? And so maybe like before that goes to the board, I think you'd want to have some kind of a support around like, what would this actually mean for participant outcomes? To getting to Blake's point earlier about like, how do you measure success? Higher paychecks in retirement, right? Does more equity allocation support that, or does that just introduce more volatility into the plan? All the upside gets pushed to the retirees, and if things go sideways, the actives are left kind of holding the bag, or the taxpayers left holding the bag.
So Brad, can you help me by formulating what questions I should be asking our actuary? Because you speak actuary and I don't. And I
Say
feel
how-
like when
how-
I feel like
yeah.
when I ask, they're like, huh? And when you ask, they're like, oh yeah, blah, 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 blah. So if you can help me with that, that would be great. Just shoot me an email with maybe what things I need to have them address, and I will get it to our actuary right away. And
Sounds good.
since
I mean, just from the group, like, did I describe that in a way that makes sense to you guys? Like, I do think that that excess earnings mechanism that makes a lot of sense for an ongoing plan. Really, once you run into like runoff mode, you get some real discrepancies in how outcomes sort of they're out over time with the plan and rundown and the active sort of left behind after the fact.
I think the only thing I would say, Brad, though, is we do see from the allocation sort of projection that the shift does more than likely, I mean, of course, we have a standard deviation component, but it does more than likely improve the returns. And although I acknowledge completely what you're saying, which is that the returns do go to everyone and the active group is by far the smallest, I still think, though, when we think about those sort of long-term concerns that we've had, the retirement group, them getting a little bit more through the excess earnings, to me is not a bad thing. That help addresses, some of them were not in a situation where there was a retirement incentive or that the 401a wasn't there. And so we've taken, now I will always argue that it's not enough. So please don't someone come up there and say we've done everything, but we are making those steps for those actives, and those folks who are retired may not have had that option or tool there. So I think that the data point is there to justify that, yes, we are increasing the risk component slightly. We're also increasing the likelihood of plan performance being better, which floats everyone's boats. And I think that that's a good thing. And I think that that meets the objective that we've talked about, even when we went back and approved the allocation being at 70-30.
Yeah,
One thing,
I hear you there. I guess what I want to be clear on, and the actuary can help us, is if you do that and you get an extra 50 basis points of performance out of the plan over the next 10 years, does proportionally, do the retirees get 4 times as much of a benefit as the actives do? And for the actives, I think it means more because you have that compounding effect between now and retirement, and then that payout in the future. And I just want to get a better understanding of, if the goal is to help the actives more potentially because they have a bigger gap to close,
Mhm.
is this the way to do it, or is there a more efficient way to do that that doesn't carry so much risk to it?
Yeah, I understand your question and your data completely.
one thing, Brad thought that I know John and I talk a lot about with excess earnings is that, there isn't a mechanism that tells us exactly how much of that, how much in gains to take per year that drive that excess earnings and that distribution. And so it's more market driven in terms of, we're taking gains on stocks when it's run up, or it's time to take gains, and we're not doing, there isn't any mechanism in the plan or in the investment policy statement that tells us when to do that. It's more just driven by our general how we do business and taking gains in an investment portfolio. And so I think, increasing the equity would seem to theoretically overall increase the excess earnings that participants receive, but there certainly wouldn't necessarily be a guarantee that occurs, because there isn't a hard and fast rule that makes that happen. Is that
We gave Kathy a random number generator years ago. That's how she determines excess earnings.
okay? Great. So it's on Kathy then. I kind of like that.
oh, thanks, guys.
I think in good stock market years, that has been a fairly healthy number. So
Yeah, we're very conscious of that in terms of harvesting gains to enhance the return, particularly the last several years where interest rates were so low. We've seen some improvement there, but we acknowledge the fact that the income wasn't going to get you to the level you needed or wanted to be at. So we have put a lot of effort into taking those gains and ensuring that we can get you there to a minimum, the required return that you need for the funding of the plan. And hopefully that'll actually spill over into the ability to generate some excess earnings. So
it's just, we know it's important, We know it's important to everybody, but we don't operate with a target, and it's very much a byproduct of, the market. What is the market producing, and what can we take from the market in any given year? So it's year by year. Any other thoughts or questions? We're right at the top of the hour, so we can certainly stay on if there are questions, but we want to be mindful of people's time as well.
Thank you
Well,
both
if
for the
anybody thinks of
dialogue.
anything,
Well, and as the dialogue continues, specifically bringing in the actuaries, please let us know how we can help that conversation or be a part of that conversation, because obviously we are very, very interested in making sure we deliver the performance that helps achieve all the goals of the plan. So definitely keep us included to the extent we can help.
Thank you. Thank you for your work on this, and I will get together information for an updated investment policy statement that we can get to the board, and we'll pass that through you guys before we get it to the board, so you can see also the reports that are going with it for the year-end reports. So, any questions? And Brad, if you can send me what important questions I'm supposed to ask, that would be helpful.
Just drop something in the chat that
Oh.
is concise
Okay.
and hopefully understandable to the plan actuary, but
Okay,
send that actuary my direction if they have questions.
okay, perfect. Any questions from anybody? Otherwise,
Kathy, did you want to give a retirement incentive update? I saw that on the agenda.
oh, yeah, I probably should do that then. We
gonna
did
need
send
to
out the
jump.
information for the retirement incentive update, and that deadline is October 1st. We've had several people send in already. So we'll see. I'll update you guys with numbers as we get closer. Lots of questions around it. Lots of questions around, are we gonna, if I don't take it now, is there gonna be one next year? We don't know the answer to that because in conversation, Dr. Roberts and Shashank wanted to wait until this deadline was met before they offer something else or consider something else. So we don't have anything in the works for immediately right now for the next fiscal year. So I'll keep you posted on the numbers of who comes in on this one, and then we'll keep working on that active group because it gets smaller and smaller.
Kathy, do we need to set a date for an annual meeting?
Yeah, we do.
I'm not saying we have to do it right now, but maybe if you want to look at some dates and shoot them back to the rest of us based on when you think reports will be done and ready.
Yeah, Mike, I need to find out. We're still working on finalizing something. We're just getting the actuarial report done, and then from that, they work on the actual annual report that they do. So that will take a look, probably not till the end of the month, end of September. So probably mid-October, hopefully. But I will verify those dates. I'm putting DMTRS annual meeting on my to-dos and investment policy statement on my to-dos.
Good. I'm
Anything?
glad your to-do list is getting bigger. That makes me feel better. I've done my job.
Yeah, I'm not talking to anybody else today because everybody I've talked to today has given me to-dos. So that's all right. I will get that done, and also probably need to look and see elections for committee members. I don't know who's rolling, and look at those dates as well. Because I know you all want to just continue to stay on because it's so much fun. So, all right. I will get that stuff done and be in contact. And do we have another meeting on the books?
November 13th.
Make sure. All right.
I think
Yep.
we'll be to our normal cadence quarterly, November 13th at 4:00.
November 13th. Okay.
Okay. And hopefully we'll have, in between there, we'll have had a annual meeting, or maybe we can have it on November 13th. So we'll see. All right. Thank you guys for your time.
Thanks, everyone. Good night.
Thank you.
Good night.
Good night.